On the 24th of July 2026, the highest-earning basketball player in history signed the smallest contract of his career. 2 years, $8 million, the veteran's minimum. For context, that is roughly what he had previously earned in a fortnight. Every headline treated it as a sacrifice, a great player taking less money to chase one more championship.
LeBron James, maybe you've heard of him, announced today he's signing a 2-year deal to play for the Philadelphia 76ers. This upcoming season will be the 4-time NBA champion's record-breaking 24th season.
And that reading is not wrong, but it is incomplete in a way that is far more interesting, because the $8 million is not where his money is. It never was. And the decision he made that week will move considerably more than $8 million. Not through the contract, but through a set of rules almost nobody reads. He announced it himself. He called it his last decision. He said he needed to work out whether he still loved the game, and concluded that he did. Pennsylvania's governor declared that Friday LeBron James Day. Billboards appeared across the city within hours, paid for by a local advertising executive who happens to be a lifelong supporter of the team. But strip away the ceremony, and a person has just relocated their professional life from one American state to another. That is not a sporting event. It is a financial one. So, this film is going to answer 4 questions. What does he actually earn? And how little of it comes from basketball? What changes when a person in his position crosses a state line? What are the costs nobody puts in the headline? And the question that turns out to matter most, where is he actually going to sleep? That last one is worth more than the contract, by a considerable margin. Start with the shape of his income, because it is the opposite of what most people assume about athletes. Across his career, his playing salary has been enormous, but it has consistently been the smaller half of his earnings. The larger half comes from endorsements, equity stakes, media ventures, production, and a portfolio of business interests. That balance has been shifting for 2 decades. In 2026, it tipped almost completely. The mechanics of the deal itself are worth a moment, because they were reported carefully. 2 years, $8 million, with a player option for the second season, meaning he decides whether to return or become a free agent again.
We got an opportunity to bring 5,000 families to the park and be a part of our reunion. Once again, we welcome our new 3rd graders.
CBS Sports noted something specific about that structure. Minimum contracts rise with a player's years of experience, and the league normally reimburses a club for the difference between a veteran's actual minimum and what a 2-year player would have earned, which keeps older players affordable. That reimbursement does not apply to multi-year minimum deals. By signing for 2 years rather than 1, his full salary counts against the club's cap, which tells you something. He chose the harder structure for his employer in exchange for a second year he controls. Now hold that next to the number. $8 million over 2 seasons for a person whose off-court income runs into the tens of millions annually. And this is where the interesting part begins, because those 2 income streams, the salary and everything else, are not taxed the same way. They are not even taxed in the same places. One more thing about that income shape, because it is the most transferable idea in this film. An athletic career is short, and it is front-loaded. The earning window closes, usually in a person's 30s, and it does not reopen. That is why so many athletes with enormous career earnings end up with very little, a subject this channel has covered elsewhere. The players who do not follow that pattern almost all did the same thing. They converted playing income into ownership, while the playing income was still arriving. Equity, not endorsements. Businesses they hold, not products they promote. By the time a career reaches its 24th season, the salary has become almost ceremonial. What matters is the structure built underneath it, while there was still time to build one. California has one of the highest top marginal income tax rates in the United States at 13.3%. Pennsylvania taxes income at a flat 3.07%. No brackets, no progressive thresholds. The same rate on the first dollar and the 10 millionth. That structure is worth pausing on because it is unusual and it explains a great deal about who moves where. Most income tax systems are progressive. The rate climbs as income climbs, so the highest earners pay the highest percentage. A flat tax removes that climb entirely. Someone earning $40,000 and someone earning $40 million pay the identical proportion. For a person on an ordinary salary, a 3% flat rate is unremarkable, comparable to what a progressive system would charge them anyway. For a person at the very top, it is transformative.
LeBron James has hit yet another milestone, this time doing something no other NBA player has ever done. After another monster year of earnings, totaling $121.2 million last year.
The flat structure caps their exposure at a rate most systems reserve for their lowest earners. That is the quiet mechanism behind a great deal of high earner migration in the United States, and it is entirely lawful. Pennsylvania is not offering a loophole. It has simply chosen a structure that happens to be extraordinarily attractive to people with very large incomes. That is a difference of more than 10 percentage points at the top end. On $10 million of income, it is over $1 million a year. But Philadelphia complicates it. And this is the part that gets left out of every comparison you will read this week. Philadelphia levies its own wage tax, one of the highest city income taxes in the country. Reported rates for 2026 sit at around 3.75% for city residents and around 3.44% for non-residents who work in the city. Stack that on the state rate, and a Philadelphia resident faces a combined burden of roughly 6.8% on earned income. Still less than half of California's top rate. But notice the structure of it. The city charges its residents on all of their earned income, wherever it is earned. It charges non-residents only on the income they earn inside the city, which means the boundary of Philadelphia itself, not the state, the city, is a line with a price attached to crossing it. Move to the suburbs, and the resident rate disappears. Keep working in the city, and the non-resident rate follows you anyway. So far, this looks like straightforward arithmetic. It is not. Because professional athletes are not taxed the way anybody else is. There is a mechanism in American tax law, informally known as the jock tax, and it changes the entire calculation. The principle is simple. If you earn income while physically working in a state, that state may tax the portion earned there. It applies to athletes, and it also applies to the coaches, trainers, and medical staff who travel with them. The modern version traces back to the 1991 NBA Finals, when California taxed the visiting Chicago players for the days they spent in Los Angeles. The calculation uses what the industry calls duty days. Every day a player is required to be with the team counts. Games, practices, meetings, travel. The share of those days spent in a given state determines the share of salary that state can tax. Duty days in the state, divided by total duty days, multiplied by salary, multiplied by that state's rate. An NBA season generates somewhere around 200 duty days and takes a team through more than 20 states. So a player's salary is not taxed by one state, it is sliced across every jurisdiction they set foot in as a working professional, and they may file returns in 15 or 20 states in a single year. Now, apply that to the move. A substantial share of his playing salary was never taxed by California in the first place because a substantial share of it was earned in other states. The same will be true of Pennsylvania. But the home state does something else. It taxes everything not already claimed elsewhere, gives credit for tax paid in other states, and keeps the difference when its own rate is higher. That is why living in a high-tax state is so costly for an athlete. California, at 13.3%, was effectively topping up almost every away game slice to its own rate. Pennsylvania, at 3.07%, tops almost nothing up. Most states he plays in charge more than that. So the move does produce a genuine saving on the playing salary. On a 2-year, $8 million contract, that saving is real and small, which brings us to the money that actually matters. Before that, the friction. Because relocating a life at this level is not free, and almost none of it appears in the coverage. There is property on both ends. A residence to acquire or lease in a new market, and existing property in California that either sits empty, generating carrying costs, or is sold, generating a taxable event and the loss of an appreciating asset. There is the household itself. Security arrangements have to be rebuilt from scratch in an unfamiliar city. New threat assessment, new local personnel, new residential systems. Staff either relocate, which costs money, or are replaced, which costs more.
We will cover the state's history, types of taxes with detailed explanations, and the various tax exemptions available so you can make better informed financial decisions for yourself or your business.
There are the professional advisors who now have to file in a new state, reconcile withholding across 2 jurisdictions in a single tax year, and handle a part-year residency return, which is one of the most scrutinized filings in American tax practice because it determines which state gets the largest share. That scrutiny is worth understanding, because it is the part of relocation that costs the most and appears in no press release. When a very high earner leaves a high-tax state, that state has an obvious financial interest in establishing that they never truly left. And the test is not where you say you live, it is a factual examination of where your life actually is. Auditors count days. They look at where property is held and how it is used, where vehicles are registered, where children attend school, where a person is registered to vote, banks, sees a doctor, keeps possessions of sentimental value. A departure that looks casual on paper can be reversed years later, with interest and penalties attached. So the genuine cost of a relocation at this level is not the removal van. It is the years of documentation, the professional fees, and the discipline of living in a way that would survive an audit. And there is a detail reported in the days after the signing that captures the scale of the friction better than any invoice. ESPN reported that he may not live in Philadelphia at all, that he might base himself in New York, and that the 2 cities are a 45-minute helicopter journey apart. As a lifestyle detail, it is remarkable. As a financial decision, it is the most consequential thing in this entire film. Here is why, and it turns on a distinction the duty days rule does not cover. Endorsement income is generally not allocated by duty days because it is not payment for playing in a particular arena on a particular night. It is payment for a name. And income of that kind is typically sourced to where the person actually resides. Look at what that means. His playing salary, the $8 million everyone is discussing, is fragmented across 20 states and mostly taxed at rates he cannot control. His endorsement and business income, the far larger figure, lands broadly in one place, the place he calls home. And that is the decision he was actually making. California at 13.3%, New York with a top rate reported at around 10.9%, Pennsylvania at 3.07%. On tens of millions of dollars of residency-sourced income, the distance between those three numbers is not a rounding error. It runs into millions of dollars a year, which means the reported possibility that he lives in New York rather than Pennsylvania would surrender most of the tax advantage that his new state offers.
I think it's great for the city. Super excited, man. I think that the Sixers will finally get a championship here now.
And he may still choose it. And we should be careful here, because this is where speculation usually takes over. Nobody has published his residency plans. Nobody has published his endorsement income for this year. Nobody outside his advisory team knows how his business interests are structured. And at this level, they are almost certainly held through entities that change the analysis entirely. What is documented is the rate differential, the sourcing principle, and a report that he may commute by helicopter from another state. And what that combination tells you is the genuinely useful thing. At this level of wealth, residency is not a lifestyle preference. It is a financial instrument. It has a rate attached. It is documented, audited, and contested. States maintain teams whose entire function is to establish that a departing high earner never truly left, counting days, examining property, examining where children attend school, where vehicles are registered, where a person votes. And it can be chosen. That is the part most people never consider. For almost everyone, where you live is decided by where the work is. Above a certain income, the work follows you, and the address becomes a variable you optimize. So let us return to what he actually did. He took the smallest salary of his career, in a state with one of the lowest income tax rates in the country, on a 2-year deal whose second year he controls, having spent months publicly deciding whether to continue at all. Every one of those choices is legible as a sporting decision. He said as much himself, and there is no reason to doubt it. He wanted to win, and he chose the roster that gave him the best chance. But every one of them is also legible as a financial structure, and that is the point. At the top of any profession, those two things stop being separable. The decision that looks like passion is also the decision that was structured, not because the passion is false, but because people at this level do not make decisions that only work one way. And there is a broader lesson here that applies well below his income bracket. Most people's financial lives are dominated by their salary, and their salary is set by someone else. Their tax rate is set by where they must live to do the work. They have very little to optimize. The wealthy invert both. Their salary becomes the smallest component of their income. Their location becomes a choice rather than a consequence. And at that point, the question stops being, how much do I earn? And becomes, where does this money land? And under whose rules? Nobody teaches that inversion, because for most people, it never becomes relevant. But the direction of travel is the same at every income level. The further your money comes from something you own, rather than something you are paid, the more control you have over what happens to it. He called it his last decision. Perhaps it was. But the contract was never the decision worth studying. It was $8 million in a career measured in billions. The decision worth studying is the one nobody announced. Not which team, not how much, which address, privilege index, where wealth isn't measured by what people own, but by what it takes to keep it.